Hello, and thanks for joining us today. I'm super excited you could be here because today we're talking about something that surprisingly I don't think we've ever talked about on the show, which is crazy because it is a business credit financing show. And we're actually talking about investing. We're actually talking about how to build wealth, how to master your money, especially with investing in the market and the things that you really should know, the things that trip up us entrepreneurs, and the things that, quite honestly, prevent us from even trying to go down this road because we just don't have the basic knowledge that we need. And I think we're going to change that today. We're going to leave this episode and have the confidence that you need to actually start investing the right way. So with us today is Jeremy Schneider. Now, Jeremy's actually an entrepreneur. He's a software developer, and he's also a personal finance educator, passionate about making investing simple and accessible. So in 2004, he actually founded RentLinx, which was bootstrapped without outside funding, and profitably grew the company until its acquisition by AppFolio in 2015. Now, that success actually allowed him an opportunity to reach financial independence and retire at the age of 36. So after exiting, he actually founded the Personal Finance Club, where he teaches millions on how to actually build wealth through disciplined saving and long-term investing. And he co-founded Nectarine, which is a marketplace dedicated to fixing the finance advice industry by basically aligning incentives. So Jeremy's mission is to help others basically find financial freedom by providing clear, unbiased education. And when he's not teaching personal finance, he enjoys beach volleyball, traveling, and spending time outdoors. Jeremy, what's up, man? Welcome to the show.
Hey, what an intro. That's crazy. It's like, I'm going to save that for my tombstone one day. I'll just put all what you just said in there and that'll cover it.
That's cool. I'll even make it into a song, and then I'll be at your funeral, which I hope never happens, but that'd be way outlive me. And then I'll be able to sing it there for you as well. Man, you've done a lot of cool stuff. So congratulations on your success.
Thank you very much. That's very kind.
Yeah, and I think we were talking before, I have to at least mention it, that your son's name is Ty, just like mine. So I think that's the greatest success that you've had. Maybe having the son and naming Ty. I don't know which one it is, but I think maybe both.
Yeah, it's actually a really unique name. And so I'm like kind of honored to talk to a fellow Ty out there. But yeah, just the two letters. And you asked me the question that everyone asked me, which is it short for something? I often give other answers like Tyrannosaurus or Tylenol or something like that, but it's not. It's just a two-letter first name.
Yeah, that's pretty cool. I probably should even ask that question because everybody asks me that question as well. So I think just, 50 years of being asked the same question, I think it's just kind of stuck in my head as a default.
It's like I'm 6'4", and so a lot of people say, "How tall are you?" And then when I see someone tall, I'm like, "How tall are you?" I'm like, "Oh, they probably are annoyed by that too, aren't they?"
I'm 5'7", so it's usually how short are you?
That's about average.
That's usually what I get out. But I love what you do because, I'm realizing and looking a little bit more into what you do, like, I suck at understanding the stock market. Like, there's a lot of stuff I understand pretty well in the business finance space. And I talk to a lot of entrepreneurs that are the same way. So why do you find that so many kind of high level people out there? I know the personal side you deal with in entrepreneurs as well. Like, why is this such a mystery for us where we're so overwhelmed and confused by anything to do with investing in the market?
I think investing is this terrifying landscape. And, in pop culture, we see images and movies of like frantic people on the floor of the New York Stock Exchange, like waving pieces of white paper over their head or guys in their basement with 14 monitors doing some complex day trading. And there's options and there's futures and there's commodities. And we hear these tales of these like Wall Street intense investing things. And then when it comes to our own investments, we're then tasked with entering that world and competing against those players that I just talked about. And so it feels like this incredibly terrifying and daunting landscape. And so I think it leads a lot of people to say, okay, that's not for me, or I'm going to do something different, or I'm just going to save money in cash, or I'm going to build a business. I think on one of your recent episodes, you said, I'm just going to build a business and sell it, and then that will be my retirement. And what I love teaching is like, it's actually everything I just described, to sum it up is kind of nonsense. And there's a much clearer, simpler path to what I believe is optimal investing, which can build tons of wealth. And I think really pairs really nicely with entrepreneurship. You can build your business and you can invest and have your money growing for you simultaneously.
So I love that. And I love that you simplify what most people deem to be very, very complicated. So give us a basic foundation. Like what are some of the simple foundational things that we should understand and know about investing?
This is like the key to the whole thing. I'm going to try to break it down and maybe under a minute if I can. And the basic key is when you go and want to enter into the stock market or the bond market, there's a million options. You could pick and choose stocks. You're like, oh, I wish I bought Nvidia back then. I want to buy the next Amazon. I should short sell this. I could day trade this. But at the end of the day, the stock market is what we call efficient, which means the sum total of all public human knowledge is constantly being priced into every single stock in the market. And so, for example, if I go and try to buy a share of Apple today, I don't know what it is, like $250 a share or something, I can use my own knowledge of the company based on how popular I think phones are, what I see their profits are, what I think their features, and try to decide if $250 is a good price or not. Is that too low, too high? But everyone else in the world is doing that too. And so it turns out that that price, to the penny essentially, has all of public human knowledge baked into it, which means it's very hard for me as an individual to have more information than everybody else combined. By definition, I can't because I'm part of that totality. And so it's basically an impossible task to go and look at a stock and individually make an assessment, is this a good or a bad price for the stock? And so that's good news and bad news. The bad news is when you're at we're coming up on Halloween, when you're at a Halloween party and your uncle says, oh, Nvidia's got a lot of room to run, you can just flatly ignore that because your uncle doesn't know any more than everyone else. And so it means it's very hard to pick and choose individual stocks. But the good news is if you do just buy any random stock, you're essentially getting the fair market price based on all, future expectations and growth and profit and all that stuff. And so what do? The answer is, instead of entering this entire incredibly scary and complex world, like I mentioned, and options and futures and stock picking, commodities and yada, 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 you just do one very simple thing, which is buy an index fund. And an index fund is simply a list of all the stocks sorted by size, the biggest at the top, smallest at the bottom, and then you buy them all in proportion to their size. That way you're guaranteeing yourself your fair share of all market growth. And so as the economies of the world do what they must do to keep the world running, technology, transportation, healthcare, services, mining, consumer, as all these businesses are growing, they're all directly pipelining that money to your bank account via this index fund. And you've basically solved the complexity of investing. And it turns out this isn't just an easy way. It's just not a beginner way. Like study after study after study show that index funds actually beat the experts over time because they're very low cost. They're very simple. And so if your entire investment strategy is open up a Vanguard account, buy shares of VTI, which is the Vanguard Total Market ETF, and just every month put whatever extra cash you have in there, you're going to beat almost all other investors. And the few investors who beat you, studies show they're not good. They're just lucky. And so it's not actually a good strategy to try to get lucky.
So break down a little bit more like what an index fund is.
So index funds have ticker symbols. So if you go and Google Apple stock, you'll see AAPL show up. AAPL is the ticker symbol, like a 4-letter little character for Apple. If you Google Vanguard Total Market ETF, you'll see VTI. VTI is a ticker symbol for the Vanguard Total Stock Market ETF. An ETF is basically a little package with a name, VTI, that contains 4,000 stocks inside of it. And so if I go open up a brokerage account with like Vanguard, Fidelity, Schwab, or any brokerage account, and I click invest, it'll say, what do you want to buy? I can type in VTI, and it'll say VTI is currently $98 a share or whatever it is. And you can say, okay, I want to buy 10 shares. And so that'll be $980. And then once you click submit, 10 shares go into your account and you own 10 shares of those 4,000 companies. And every day, as those companies are growing and releasing earnings and profiting and innovating and becoming more efficient and all the things that great big companies have gotten really good at, the price of your shares is going to fluctuate. Sometimes it goes down, sometimes it goes up. Over the history of the stock market, the index has gone up about 10% per year. And over time, that 10% per year results in compound growth, doubling every 7 years or so, which can turn into massive amounts of money over time. And so when you are regularly contributing to VTI, the Vanguard Total Stock Market ETF, you are getting this essentially historical 10% return. And part of that, like I said, is the share price, the fluctuations we hear on the news. The Dow Jones is up $200 today. When you hear that, your shares will go up. But also it pays dividends. So as the legacy companies, Apple and AT&T and FedEx and Home Depot, as they pay dividends, those are cash payments from the profits of the company back to the owners. Those dividends come out of your VTI. You'll see dollars appearing in your account for free. It's kind of like interest in a savings account, except it's more. And you can do what's called reinvest it. So those dollars that are getting paid out just for owning it, just for sitting on it, doing nothing, you can buy more shares of that, which accelerates that compound growth. More shares, more dividends, more price appreciation. And it's very, very simple. It takes 3 minutes to set up, and then you could become a millionaire just by investing a few $100 a month.
So with that being the case, well, why do you think that an index fund makes more sense? Because what a lot of us hear is that people are investing in Apple or investing in Google, for example. And that's what we hear on the streets, right? Is people are investing in this or this or this. So why do you think that an index fund makes more sense than investing in individual companies?
So first I'll say, when I buy an index fund, it contains those companies. So I do invest in Apple. I do invest in Google. I do invest in NVIDIA. In fact, I was investing in NVIDIA back in 2015 when it was 21,000%, before the 21,000% run up we saw over the last 10 years. And that is kind of the answer to your question, which is it's very, very easy to look backwards and tell what the best stocks were. I literally, despite being an expert in this and teaching this every day, I fantasize about going back in time 10 years, just 10 years, not that long, 10 years. And I could become a multi-billionaire by making leveraged plays on NVIDIA, on Bitcoin, on, short selling the 3 months of 2020 or at the beginning of the pandemic, and then, leveraged purchases the rest of the year when the market ended up 18% during 2020. That's very easy to know looking backwards. But today, here we are in, soon to be late 2025 looking forward, what's the next NVIDIA going to be? When is that next crash going to happen? When is that next opportunity to short sell? When's that next opportunity to leverage and buy? And the answer is, I have no idea. And nobody else does either. A lot of people say they do, but study after study after study after study show the experts who say they know what's going to happen are wrong. They're wrong as often as a broken clock is wrong, right? They're just guessing and sounding smart. And they're very smart people. They have reasons for their thoughts. But like I said, the market's very efficient. And so if someone says, hey, Jim Cramer is the obvious example. He's hitting his bells or his bears and his bulls and squeaking horns and saying stocks. And kind of the running joke on Wall Street is there's one of my favorite investing articles of all time is, it says all the Jim Cramer viewers from 2005 are now billionaires. But it's from The Onion because it's a joke, because of course it's not. Because even though this is a very smart guy in Jim Cramer, he has very deep knowledge of the system, looking forward, he has no idea what's going to do better, right? And so that's why instead of guessing and introducing risk and over concentration of certain stocks into your portfolio, you buy it all and you guarantee yourself your fair share of all the market growth.
So it basically is diversification of risk.
Totally. You diversify away all risk of individual company ownership and guarantee yourself the total market growth, which has been fantastic over history.
Now, in what you do and invest, do you invest outside of the index fund? Are you in one index fund? Are you in multiple index funds? Or are you in one index fund and or multiple, and then individual outside stocks outside of those index funds?
There's a lot of right answers to that question. One of my absolute favorite ways to invest is to buy exactly one thing, which is called a target date index fund. And very, very active investors would roll their eyes target date fund. But they're going to lose to this strategy, right? Their identity and maybe their career based on charging fees to trade doesn't like that. But the reality is a target date index fund is one index fund with one ticker symbol. And there's a bunch of them. There's a bunch of versions based on the year you expect to retire. So there's a 2050 target date index fund, for example, and you can Google them to look up what the ticker symbols are. Then inside of that fund is basically three major things: a US stock market index fund. So you buy all the US stocks; an international stock market index fund. So you buy all the international stocks; and a bond index fund. So you buy all the bonds. And they're in the right proportion. It has a balanced asset allocation based on your age. And so if you're 20, you're basically all or mostly all stocks, because if the market crashes when you're 20, amazing, because you're going to be buying a lot more stocks at a discount. If you're 70, you don't want your portfolio to get cut in half when you're 70, because you want to be collecting income from that portfolio to spend to live off of. So it's more bonds, more like 50, 60, 70% bonds as you enter 70s and above. And that all happens at one ticker symbol. And so that's one way to do it. Or you could buy them separately. You could buy VTI, which is the US stock market ETF, VXUS, which is the international stock market ETF, and BND. That would be called a 3-fund portfolio, which is essentially identical in makeup to the target date fund. It's a little more work because you have to choose how much of each one to buy and reallocate over time as you age. And you could buy more. Personally, I like the 90-10 rule. 90% of my investments are going in either into a target date fund or a 3-fund portfolio. With the other 10%, kind of to answer your question, I go nuts. I guess. I bought some Rivian stock the other day because I was looking at Tesla, I was looking at Rivian, I was looking at like what my friends are saying. Right now I have 4 friends like I play cards with. We all show up in a Tesla, which is like so annoying, I know. But they all want Rivians for the next car. And I was like, I don't know. I think this might be where the market is moving over the next 5 or 10 years. Am I right? No clue. 100% a guess. But for me, that was just my, lotto money, just seeing if I'm as smart as I think I am with picking stocks.
Are you? Like, how's your 10% worth so far? Just out of curiosity.
I do it so little. And that's a very good question because people don't want to answer that question. When you really do a careful audit of how your stock picking is doing, not relative to zero, but relative to the market, almost everybody's losing. Because you're introducing bid-ask spreads and fees and cash drag and all this expenses of messing with your portfolio. Like one of my favorite quotes is, your investment portfolio is like a bar of soap. The more you touch it, the smaller it gets. The best strategy is just regularly buy the index, leave it alone, let compound growth and the growth of the companies do the work. Don't mess with a lot. That said, like when I sold my company to AppFolio, I made the biggest stock purchase of my life. I bought $435,000 of AppFolio stock, which was at $12 a share. And now it's at, I think, 200 something a share. But I'm an idiot, and I sold a lot of it at $24 a share and called myself a genius. And I sold almost all of it at $80 a share and called myself a super genius. Had I held it all until today, that would have been like close to $10 million or something. But I, made like $1 million off of it or whatever. And so, that part I think did outperform. But I also bought Sears Canada a few years back. And I was like, okay, Sears in the US isn't doing well, but Sears Canada, that's like the target of Canada. The Canadians love it. I had this whole theory in my head, went out of business. I lost it all. And so, I think because of that portfolio stock, I'm probably north of the index, but I've had plenty of losses too.
So do you do the 10% more for fun than anything else?
It's partially for fun. And I'd say it's partially a release valve on the FOMO of being tempted to put my 90% at risk, right? I don't want, if I say, hey, you can't do any of it, it's like total abstinence. You can't ever pick stocks. You can't do any research. I think then that would be kind of like depriving myself too much. And then I might be putting the whole thing at risk when I was like, oh, the index is down, screw this. So I think it's like, it's the release valve on the FOMO and some education, because I was like, oh man, if I'm being honest, I bought some Lyft stock too, which 5 years later was half of what I paid for it. And I was like, I'm selling this for the tax loss now. So, I think when you have that education happening, it gives you a lot of confidence in your 90%, and you're glad that it's still there and growing and, growing exponentially over time.
Yeah. And I love how you describe that too. Like it's kind of insurance on the FOMO. Like it makes sure that you leave the 90% safe and you have the 10% to kind of go off on wild hunches or whatever maybe. Do you put your 10% into things that are just like, Apple and just leave it there? Not all of it, but do you put some of it into stuff like Apple or Google or Tesla, or you just don't even expect to mess with it for years to come?
I don't because I own Apple and Tesla and Google inside my index
in the
fund.
index
And so, for me, it really is more of like the lotto ticket. I'm like, I'm just seeing if I can, pick the next NVIDIA before anyone's talking about NVIDIA. But still, to your point, I still think, even though that's what I'm doing, I think buying and holding is the correct strategy. Like if I buy something and sell it a month later, if I bought NVIDIA in 2015 and sold it in, early 2016, maybe I would have made 30% and called myself a genius. But now it's up 21,000%, right? And so I still think the money is made. I think it was Charlie Munger who said the money isn't made in the buying or the selling. The money is made in the holding. And so I think what you said is really good behavior. But I do with my index funds. So I purchased index funds, decades ago that still have that same basis from decades ago, and they're just growing.
And you're talking about, and I love that. And I really drilled down on the 10% because that's kind of what the crazies do. I'm not calling them all crazy, but I just think it's interesting that you've got a strategy that's really, really stable. And then you still build in a buffer just to kind of go crazy and hunches and just, having poker with the guys. And they're like, we're buying this. And you're like, well, I'll buy that. I don't know. We'll see how it goes. I think that's really cool. So I want to reiterate that, your strategy is these index funds, especially these targeted index fund. I just like to talk about the playing part because I think that's where a lot of other people live. And unfortunately, most of them do not do well, which I think is interesting in itself. So the target index funds or the index funds in general, do you have ones you recommend people to people that you like the most?
Yeah. You're exactly right about the 10% being more fun. Way better conversation, way better TV, way better news. I make a daily post on Instagram about this, and it's kind of a challenge because I don't do anything different. I don't have like a hot take every morning. I'm like, oh, did you see the Fed rate do this? It means bad things for incoming tariffs. None of that matters to me because I'm just holding, and so it just takes a very, very disciplined, wise investor to have confidence in that buy and hold strategy. What did you ask?
Well, I actually, and I know it's just Stevens down that point. I think I love that. And I love that your strategy overall, because you're doing the discipline stable thing. And, Jocko Willink says discipline equals freedom, right? And I love that you're doing that. And then, like you said, it's like no, good story ever starts with staying at home. It usually starts with tequila of some sort.
Right.
Exactly. It's 10% like tequila. It's like, let's go crazy. That's the conversation. That's the poker conversation. That's the having friends. So I overall, I love that strategy. And I think is that what you teach a lot to your audience, is this build stability, target index funds. And then the 10% is just go have a little fun, take your wildest guess. Maybe you'll hit a home run, maybe you won't, type of thing.
Totally. And, another argument for the 10% is that if you're right, 10% is plenty. Like if I put 10% of my portfolio in NVIDIA in 2015, that'd be like $1 billion or whatever, And so a little bit is plenty if you think you're going to outperform the market by 20%, that's going to quickly grow to balloon. But it's also small enough that if you're wrong, then you're fine. If you end up with if it goes to zero and your nest egg goes from 100% to 90%, it doesn't mean you're now living in a box. But what I see too often is people who confuse short-term random volatility with correctly predicting their skill, right? They said, during COVID, I knew Zoom was going to be huge. And so I bought Zoom and I went up 20% and I sold. I'm really good at this thing. But then the next time they do that, it goes down by 90% and they're ruined. That's why I don't like to gamble with the 90%. And, it's just so brutal because the people who are chasing those big wins, they're going to do the math 20 or 30 years later. And if I had just done an index fund, I would have $6 million now. Instead, I have $50,000 and I'm trying to catch up and now get that $50,000 to go to $6 million. And it's something that I've been utterly unsuccessful in doing for 30 years. I now need to do in order to retire. That's not where you want to leave yourself.
Yeah, it makes a lot of sense. One of my buddies was convinced he was going to be a professional gambler until he lost. And then I never heard about him talking about professionally gambling again. It's kind of the same thing. When you talk about your 90%, what do you advise? What are the index funds, the targeted index funds? Do you have some specifics that are better that you recommend because you've been in them for a while?
Yes, that's a great question. And so it's a very good question. What's the best index fund? And the answer is there isn't really a best index fund because there are a bunch of different ticker symbols, and I can rattle a few off, and I will. But when you chart them against each other, they look like a line. So if I chart all the U.S. stock market index funds on top of each other, they have a lot of variance in terms of what they do. Some follow the S&P 500, which is an index. Some follow the total stock market, which is 4,000 companies instead of 500. Some are mutual funds, some are ETFs, some are offered by Vanguard, some are offered by Schwab or iShares or Fidelity. And so there's all these different options, but when you chart them on top of each other, it looks like a line because they all have the same job, which is to follow the entire market. And so it doesn't really matter which one you buy. What it comes down to is basically minimizing your expenses. There's a great study that I saw that basically looked at like 11 factors of a mutual fund. A mutual fund is basically a way to have an expert pick stocks for you in a big basket of stocks. And they looked at like the tenure of the manager and the Sharpe ratio and the Morningstar rating and the trailing performance and the fees they charge and like 5 other factors. And they found that of the 11 factors, 10 of the factors had no correlation whatsoever to success. Morningstar rating, past performance, tenure, experience, yada, 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 had no correlation. The one factor that correlated to success was the fees. The higher fees that the manager charges, the lower your performance was. And that's because they're taking those fees out of the fund. And so if the market returns 10% and they're charging 2%, you get on average 8%. And of course, there's variability. Some years they might do better, some years they do worse. But with that 2% fee coming out every year, when you stretch out the timeline, you underperform by 2% per year, which over an investing time frame of 30 or 40 years is going to erode over half of your money, which is crazy. And so what I'd look for in an index fund is just look at the expense ratio. VTI, for example, has an expense ratio of 0.03%. So instead of 1% or 2%, it's like 50 or 60 times less, whatever that is. Anything over like 0.2%, I would consider to be high, something I wouldn't invest in. And anything over like 1% is like crazy high. But yeah, you can find tons of index funds that are like in the 0.0 range, 0.03, 0.04, or 0.1%. At that range, they're all so low, it kind of doesn't matter. And yeah, Vanguard kind of popularized the index funds. And so, VTI, VXUS, and BND are the kind of 3 main total market ETFs.
And I appreciate that. And I think it gives us a good idea of where we can go that's stable. It's an overall strategy. I love it. Now, you talked about fees. You talked about, how they make less when they charge more. And you've also got something with this flat fee financial advice. So talk to me a little bit more about that.
Thank you for that softball question, Ty. So back in the day, everything that we're talking about, in order to even invest, when I say back in the day, I think you're probably about my age, maybe younger, I don't know, but like our parents, when they invested, they had to basically go through a stockbroker or a financial advisor just to have access to the stock market, because this was like 60s, 70s, 80s. You like mailed in a form to your broker, and they went to Wall Street and purchased the funds. These days, we have apps. You can open up your phone and click buy, and you have direct access to the stock market. And so, but then it kind of creates a problem, because now financial advisors, they generally charge a percent of your assets. So kind of like I mentioned, if you have a financial advisor who's charging you 1 or 2% per year to just click buy for you on these index funds, that's going to erode your growth. That's going to like really tamper your compound growth. And so when people ask me about this, they say, okay, Jeremy, I really like this, but I still want to talk to someone who's an expert who can walk me through this. And I give them the pitch. I say, don't pay these annual compounding fees, and certainly don't go to a financial advisor who earns commissions for the products they sell you, which is what a lot of them do. And so I would say go find a flat fee financial advisor, someone who charges by the hour or by the project, and then just for the advice. And then they have no ulterior motive to sell you something or to get you locked into these long-term fees. And whenever I was talking to someone, they would say, yes, exactly. Now that you say it, that's exactly what I want. How do I find one of those? And my answer was, I have no idea. It's a very uncommon business model these days. It's very hard to find. And so my co-founders and I built this company. We built a company called Nectarine, which is a marketplace for flat fee financial advisors. And so if you want to go find a financial advisor who doesn't earn any commissions, doesn't sell you any products, doesn't charge any annual compounding assets under management fees, you can go search, you can see their price, you can see their reviews, you can book online, you pay with a credit card. And I think the experience, a lot of people have negative experiences with financial advisors because they realize it's actually a salesperson who just has this like kind of very conflicting motivation from them. But when you sit down with a flat fee advisor, suddenly like the clouds clear, the sun comes out, they're like, oh my gosh, they just are trying to help me in a way that makes a lot of sense. And so, yeah, it's at Nectarine. And thank you for letting me throw in that pitch.
Yeah, no, and I love what you're doing there. I think that's brilliant. Everything that you're teaching out there. So where should everybody go to be able to, people are want to do a couple things. Where can they go to follow you? Like, you give a lot of advice out there. You've got millions, I'm going to say, of followers when I've looked at your social channels. So it's a lot of people finding you for advice. Where can they go to follow more and get more of you advice wise? And where can they go to learn more about the flat fee financial advice as well?
So you can learn about personal finance investing. It's called Personal Finance Club. Basically, everything's free. It's just like basic good information on how to invest. Instagram is where I do most of my stuff, at Personal Finance Club. We actually just launched a podcast too, the Personal Finance Club podcast, or personalfinanceclub.com. And if you're looking for that flat fee financial advisor, it's at hellonectarine.com.
Perfect. Jeremy, thanks for coming on with us today. This was really informative. I love your strategy, and you practice what you preach. Like, it is the simplest way I've ever heard somebody break down investing. And I appreciate you doing it with such grace for all of our audience. It means a lot.
Thank you, Ty. It's an honor. Thanks for having me.
All right, man. Thanks. So listen, a couple things you should do here. First of all, go to personalfinanceclub.com. If you go to personalfinanceclub.com, there's a ton of free information there, including the blog. And if you go to the bottom, on the bottom left, you can access his social channels, and you can just subscribe. It takes less than a minute. A million plus probably subscribers if you look across the social channels. So he gives really, really, really good advice. You don't get to that level if you're not giving out really valuable information. And of course, he just simplified things here. We scratched the surface. There are so many more things that we could have dove into. And we had that discussion before we even started. So make sure that you go to personalfinanceclub.com, personalfinanceclub.com. Take less than a minute, bottom left of the website. Just go and subscribe on his social channels. But the other thing you should really do is make sure you go to hellonectarine.com as well. If you go to hellonectarine.com, then there you can find a list. You can even expand the list out of the flat fee financial advice and the advisors. And there's a couple different options that you have there that you can actually choose from based on what works for you. A comprehensive education that you can get, or even just go and get the advice that you want with small increment sessions. So you can get that at hellonectarine.com. So take a minute right now. It takes less than a minute to do those things. Go to hellonectarine.com and make sure you go to personalfinanceclub.com. And while you're there, make sure you subscribe to Jeremy's social channels so you can get ongoing financial advice. Look, don't hang your hat on selling your business, because so many entrepreneurs put all their eggs in that basket. And then, I hate to say it, but it doesn't turn out. You don't make as much as you want, or maybe you never exit. You want to be doing both at the same time, and you can, right? You can be building wealth, building a business, taking some money and putting it aside in the right strategy, and set yourself up for success both ways. So make sure that you go ahead and do both. Personalfinanceclub.com. Check it out, and hellonectarine.com as well. Thanks for tuning in. Take care. Have a good day.